All views, opinions, and comments expressed herein are solely those of the speakers and do not necessarily reflect the views or opinions of StoneX Group Incorporated and/or its subsidiaries. This content does not constitute an offer or solicitation to open a trading account, to trade in any specific product, or to engage with any services provided by StoneX Group Incorporated or its subsidiaries. This content is not intended for residents of any particular country or jurisdictions where such content is prohibited.
Welcome to the Trading Global Macro Podcast from StoneX, where we unpack the complex forces driving the financial markets. I'm John Kicklighter, Global Head of Content at StoneX.
And I'm Matt Weller, Global Head of Market Research for StoneX's self-directed brands. Each week in this podcast, we explore the macroeconomic trends and the geopolitical events shaping Forex, equities, commodities, interest rates, and more. Happy New Year to you, John. Happy New Year to all of our listeners. What is our topic today?
Happy New Year. We are going to, I think very appropriate for the market conditions we're seeing now at the beginning of 2026, cover something that has some corollary to one of the episodes we've done before, and that was on bubbles. We're going to be talking about trading in extreme market conditions. So extreme market conditions can be of differing types. You can gauge something as extreme by a number of different ways. But we're going to go through, I think, some of the ones that we see most regularly and potentially talk a little bit about how to incorporate into your analysis. And again, when you approach markets from your personal perspective, you should always know your tolerance for risk. This is something we've talked about in a number of the past episodes as a component of it. But if you have a low risk tolerance and you perceive markets as being somewhat extreme in terms of conditions, it's probably best to avoid those markets. It's just your risk tolerance. I see some of the greatest flaws in trading plans born of somebody trying to force something in a market that really does not suit their own approach. So if you find that you have a low risk tolerance and you're analyzing markets as being extreme conditions, it's probably best to avoid it and look for another market or waste your time. But that being said, that little risk disclaimer out of the way, I think we want to start on extremes in terms of price, but I think there's two ways that you can measure these extremes. One of them is extreme levels. So you can have, for example, I think one of the most recognizable is record highs and record lows. And the other is extreme movement, so the measure of change. Let's start with price. How do you evaluate, and we can pull up here a chart of, I think, silver, very appropriate one for the time. And how do you measure these kind of things in your own analysis? And how do you think it gets incorporated as a trading component?
Yeah, I think by my definition of extreme, perhaps the intensity of the move, I think is the word you used, is more appropriate for this webinar in terms of intensity. There are things like the stock market, right, that have a durable premium that generally or very frequently do trade at quote unquote extreme prices. By the literal definition of extreme, an all-time high is extreme, but we had 40 all-time highs in the stock market last year. We had I think 60 the year before. We had some 20 or 30 the year before. So for the context of this webinar, things like that, I wouldn't necessarily consider extreme, because those types of quote unquote extreme moves, not moves, extreme prices are sort of expected over a long enough time horizon. But broadly speaking, for things that don't have that sort of persistent tailwind and durable risk premium, first of all, I sort of like to put it into context. You know, this move you had mentioned silver. Silver crossed the high that we saw back in what was an extremely extreme period back when the Hunt brothers tried to corner it in the 1980s. But it basically was the highest price it had traded at in 50 years. And that has only accelerated from here. So it starts by sort of recognizing how extreme the move is. And a lot of times you have a chart that's zoomed in, maybe a daily chart or even a weekly chart might not capture these moves that go back decades. But when you have that context, you have a better framework to say, has anyone who's at their trading desk seen prices at this level before, or is everyone in the same spot? So I think that can kind of help with evaluating the psychology around a move, and then that does spill into sort of that second definition of extreme prices, and that's move or the scope of it. And you can see it sticking out for our viewers here on the silver chart. It's been straight up for several months now. The type of move we saw is a doubling or a tripling of where the price was previously. And I think by that definition, and essentially any definition, that is an extreme move. So that sort of sets the context for using some of the strategies that we'll be discussing throughout today's webinar, or excuse me, today's podcast. But would you add anything there in terms of how you're evaluating some of these extremes, John?
So I like your segmentation. You're distinguishing between price levels and price movement. It's certainly the case when you look at something like equities, that it can continue to rise. There's a monthly chart of the S&P 500 for those that are watching. And you get these persistent record highs, which is not at all uncommon for a financial asset like this, because there is natural accumulation in terms of value. There's also some considerations of devaluing of currency, which is a lot of tinfoil hat theories around as well. But it does lean into one of the oldest sayings, allegories within the financial markets. The markets can remain irrational long as you can remain solvent. So it might seem extreme, but it can always be more extreme. And that's something that is absolutely true of a record level in price, whether it be record high or record low. But it is the pace of movement. As long as markets don't change fundamentally under underlying structure, and you have a normalcy in those terms, you're not likely to see a continued extreme momentum or price movement. So if I were looking at a monthly chart of silver and I were looking at the rate of change, we would see massive monthly moves, a series of them. Scan it out over 5-6 months. It's an extreme move over that period. Now, this can exist because of supply considerations in the case of this commodity, but it can be due to temporary factors like a supply-demand consideration, a news change, a change in how the markets operate, the introduction of a new market that's competitive, and there's a list of these options. But the markets will eventually price in those norms, and you will normalize. And price action will return to some level of normalcy in terms of day-to-day, week-to-week, and month-to-month. So this is an extreme in terms of the movement that is likely to normalize. A price level doesn't necessarily normalize. A great example of this can be seen in something like the VIX Volatility Index, which is a derivative of the S&P 500's options, and it talks about the implied or expected movement of the underlying S&P 500. And yes, you see sharp increases in that volatility, but it will normalize. That average can rise and change over time to anywhere between 14 and 23 is the standard over the past couple decades, but you will normalize. And that's where I think you start incorporating this into your analysis, because if you keep chasing and saying that record highs in the S&P 500 are overdone and it just has to reverse, and you keep trying to pick tops, I'm going to tell you right now, it's not going to work out too well. But if you say that, wow, the volatility on this market or the rate of change is so extreme that I think it has to normalize, that is a practical expectation, and it is backed by statistics. So that is a little bit more reasonable. Again, people that are trying to time everything, it's best to look for confirmation, and you'll miss some of moves in terms, especially as it changes, especially direction, but also tempo. But it's better to get that confirmation than trying to absolutely top tick or bottom tick a market, because it's just such an impractical approach. So price extremes, certainly very interesting. Another one that you mentioned before we started was liquidity, which is something that I think we just came out of with the Santa Claus rally and the year-end, year-begin period. What would you add for liquidity, and what do you think that contributes?
I think liquidity can be both an extreme condition in of itself. You mentioned, kind of a seasonal pattern that we see to liquidity, but oftentimes when some of these other things are going on, that's also you can see extremely low liquidity. But broadly speaking, I think, again, it's just be aware of it, try to quantify the extent to which liquidity is present or absent. And ways that you can make this more tangible, more actionable for you are evaluating things like the volume, looking at the bid-ask spread. If you have excess, in some cases, level 2 quotes can be useful to see sort of the depth of the market. And for most of our listeners and most of our liquid global macro markets that we talk about, you're probably not going to move the market in and of yourself. This is something large asset allocators have to be aware of, but you can pay a higher price just to cross that spread. And especially if you're trading across a short time frame in low liquidity environments, if that spread is a bit wider, that can cut into your profits or even potentially tilt the probabilities one way or another. So I think being aware of liquidity conditions, and especially if they're extreme, the theme of today's podcast, though that's something that you can't ignore, and a bad period trading through low liquidity is something that can unwind months of successful trading prior. So being aware of that, keeping that top of mind, and again, going back to what you said at the start, either trading smaller or sitting it out entirely are ways you could also look to manage very low liquidity conditions from that extreme.
Yeah, and I'll add, there's really the distortions that you get from extreme high liquidity are it just re-intensifies the underlying conditions of the move. The markets are more capable of observing or absorbing new event risk. So it's actually less disruptive when you have extreme high liquidity. But when you have extreme low liquidity, that's when things start to distort. You can get it structurally, like I've observed in the S&P 500 E-mini futures and open interest. We've generally had a downtrend in the use of that market in the futures area specifically, and some of it's shifted out to other derivatives like the ETF world and proxies for the S&P 500. But this can increase the volatility of the underlying. But then there's also the general low liquidity that you get during seasonal conditions, so temporary. And I won't say like in the equity world, although that does happen, but I think a really great example of this is actually the dollar yen. And I'll say because the Japanese finance ministry, who has a influence over monetary policy in Japan, they have acted on interventions at multiple times over the past decades. One of the more recent ones that we had just a few years ago was actually around a effort to impact the exchange rate, and they did so at the lowest possible time for which they think that the normal markets are liquid, and that is in the Asia Open on a Monday. So they know that they don't have really deep markets that they have to contend with, and they could actually make a trade. So back to what Matt was saying about large influences, they know that they can have an amplifier effect because there is very little market to contend with their impact, and they can kind of shock the market and look for that follow through. I think ultimately they didn't have a whole lot of follow through, but that's what can happen. So that's what I'll add to that. Another theme of extreme conditions, we have uncertainties. Uncertainties, I think, around we can qualify it around themes. So not knowing what our fundamental themes are, and suddenly something comes roaring out of the gates, out of the blue. So you can say a gray swan or black swan. But then you have also the impact of extreme conditions around event risk. So I'll take that first one. This week, at the time of this recording, we're going into the non-farm payrolls. So the first regular monthly Friday non-farm payrolls that we've seen in a few months after the U.S. government shutdown. But I think one of the more interesting considerations of trading into a major piece of event risk is it actually quiets down when you're heading into that uncertainty. People don't want to take a huge position with a definable directional call because the event risk can come out better or worse than expected and send something like the US dollar, the Euro USD, either sharply higher or sharply lower, depending on how focused the markets are on that event risk and how big of a surprise it is. So it's a huge risk to take if you have a clear, definitive view and you don't know that uncertainty. So you have an extreme quiet before major event risk, Also, you can see other events like a G7 meeting or a FOMC rate decision. But then there's also the capacity, though not consistent, that you have that volatility with the event, depending on how it comes out. So there's the scheduled event risk, which I would not recommend taking a major position. I've been in this game a long time, and I've worked with a lot of analysts that have tried to do this, as well as individual traders. Let's just say that the hit rate is less than 50-50 about calling it properly in terms of how the market's going to surprise. Because it's not just a better or worse, it's also an unimportant. So it doesn't actually render a big movement at all in consistency. Worse is you can have a surprise that is an initial shock in one direction and then quickly reverses the other direction. So if you have that kind of risk profile that you want to take low risk, I would not take a big position heading into a major event risk. So I'd say that. What would you add in terms of thematic uncertainties?
There's, and this ties in with another one we have on our show sheet here, but there's the potential for regulatory or changes and things like that as we speak. You mentioned the non-farm payrolls report. Any given Friday, that's probably the biggest event risk we have. But one that I know you have marked as well is it seems likely the Supreme Court will make a decision on President Trump's tariffs and whether those are indeed legal. That's something that has been a dramatic theme throughout the past almost year now, and I think that could almost trump NFP in terms of significance and doesn't fall into any of these buckets we have before. It certainly presents some uncertainty, but it also, when you know there could be a big shift that could impact the investment returns and market movements for not just today, this week, this month, but potentially for substantially longer. That's the type of large, uncertain, still sort of scheduled event risk that you would want to be aware of. And I just want to reiterate your point there. I think of the analogy of maybe like a surfer or something, where you're usually surfing the waves of the market. You know what kind of wave or what kind of trade you're looking for, but then you enter this period where there's not a guarantee that there's a tsunami of volatility coming, but there's certainly a higher probability around some of these big event risks. A lot of times that makes sense to go to shore, bring in some capital, or at least reduce your position size, shorten your time horizon for your trades. And I'm not going to stretch the surfing analogy any further, but you get the point here that when you can identify it in advance, that's why so many traders say, okay, well, my normal strategy might not be relevant here, so I'm going to move to the sidelines and come back once that risk has passed us by. So that's another strategy you can use throughout these periods, whether that's regulatory uncertainty, scheduled event risk, or we haven't really touched on the sort of black swan type of event where something comes completely out of the blue. So that's something else that you may want to consider different strategies for. Anything in that vein, John, or anything to add on these scheduled event risks?
Yeah, I'd say that it's really the discernment between a gray swan and a black swan. The gray swan, you know there is a probability and it's a possibility. You don't know the time frame and not necessarily the intensity, but the probability of the impact should it come to pass is going to be significant. And it can obviously, you can skew into the black swan territory, but the upcoming Supreme Court decision on whether President Trump has full carte blanche on applying tariffs is a gray swan. We know it is coming up on Friday. You also have, I think, a good gray swan that is quite significant, though. It goes into the world of crypto. So if we were looking at the crypto market, the regulatory shift and stance, where previously, just a few years ago, it was just untouchable by any of the standard financial or TradeFi groups, and then suddenly they changed their tune this past year, and now the adoption is massive, and it's had some interesting impacts on the likes of Bitcoin, where it's actually, I think, less volatile than it's been in the past because it's more of a standard financial market asset. And then you also have, I think, like betting markets are also a gray swan. Their adoption and major players that are actually getting into that area are starting to offer new products, and that can impact traditional products, offer new opportunities for new markets to trade. But those are, I think, generally gray swans. Black swans, just coming totally out of the blue. I think from this past year, the attacks on Iran were a big one. But these are those that you can't really schedule for. Race one, you can have a strategy. You can say, this is a scenario that I see as being practical for the future. Don't know when, but it will be quite substantial because the markets can't price it in properly, and pre-pricing it in doesn't make any sense because it could be waiting for Godot. So when it does come to pass, I see the headline, I can have if it's this way or that way, this is how I'll approach the market. But Black Swan, you really can't. You can't really have that that preparation because it's completely out of the norm. Doesn't mean you can't approach that from a consideration of how to incorporate and how to adjust for your analysis and your trading. It just means that when you see that black swan, it's probably going to be all pervading because it has to be repriced, and it's a much bigger consideration than everything that's marginally priced in because most of it's known. So it's avoiding and de-risking, and then expecting subsequently the markets to return to norm. However long that time frame takes, it will return to some norms. Going back to what we said about price levels and price activity intensity, those will return to some level of norms. Price not necessarily having to go back to where it was before that surprise, but keep that in consideration. And then I think the last one on our list, and I'll let you take this one, is because it was your suggestion too, the correlation breakdown.
Yeah, and this certainly it's another one of those that falls into both a symptom and in and of itself an extreme market condition. But a lot of times when we have these black swans, when we might have a big regulatory change or an unexpected financial crisis, something like that, that's where we see the usual correlations between different markets can break down, or you could even say accelerate. There's a saying, in a crisis, all correlations go to one, and that's essentially getting around the idea that 90+% of the time, having a diversified portfolio of stocks and bonds, maybe real estate, gold, who knows, but they might all move their own way. But if they continue to move up, that means your overall portfolio isn't as volatile and you can have a smoother ride. In a crisis, that can break down and they could all move in the same direction as everyone focuses on the return of their capital rather than the return on their capital. Essentially, they just want to hoard liquidity. And this in and of itself is a very extreme condition where, and this one might be most relevant to longer term traders, but if you usually rebalance your portfolio, if your stocks fall, you might buy more stocks or vice versa. In those types of scenarios, that type of rebalancing doesn't make sense. Or you might have a trading strategy that looks at the correlation between some carry trade currency pair, say Aussie yen, and the S&P 500 and tries to capitalize on those. Well, if those correlations are not following the usual script, perhaps that's the most extreme example of a situation where you might want to step to the sideline or at least dramatically reduce your position sizes. Because again, it's a symptom of these very extreme conditions that permeates across all global markets and really all investments more generally. There is one more thing I wanted to note just as a general strategy for trading these extreme conditions. This is the type of environment where you might want to be more inclined to lean toward limit orders, to if you have the option, pay for guaranteed stops, things like this, so that you don't get run over by a market that's only trading in one direction. I'm reminded of, for example, when the Swiss National Bank dropped its peg with the Euro Swiss moved very dramatically, and you could have been looking to buy at, say, 118 or something, but not gotten filled until 110. So these types of extreme moves, again, are all about protecting your capital. And these are some of the strategies that you can use to stay in the game for those extreme conditions for when conditions normalize and hopefully allow you to get back to your usual strategy. So anything else to add for you there, John?
No, very good. No notes. All right. Thanks for tuning into the Trading Global Macro podcast from StoneX. If you enjoyed today's discussion, make sure to subscribe wherever you get your podcasts. I'm John Kicklighter.
And I'm Matt Weller. Join us again next week for more insights into the trends and events shaping the world's financial markets. Thank you.